Everyone, this is Modula and Podrick, and we will be informing you all about what is going on in the digital world.
Welcome to the future humans. Let's start.
Have you ever had one of those moments where nothing makes any sense? Well, that's pretty much been the crypto market for the last few weeks. We've been hit with this wave of what should be amazing economic news. I mean, the kind of news that should send prices absolutely soaring. But instead, the exact opposite happened. So let's get into this puzzle.
Yeah, this is the big question, right? Good news is literally everywhere you look, but the market? It's just a sea of red. So what is actually going on under the hood that's causing this massive disconnect? Let's break it down.
All right, so let's call this what it is, the crypto paradox. And to really get it, you have to understand just how good all this economic news was supposed to be. Seriously, on paper, this was a dream scenario for pretty much any investor out there.
I mean, just look at this stuff, a flurry of bullish signals. The Fed comes out and cuts interest rates. That's usually rocket fuel. They also confirm they're ending quantitative tightening, or QT, in December. That basically means more cash is supposed to be flowing into the system. On top of that, the big Trump Z meeting gets called a 12 out of 10 success. And as if that's not enough, 85% of S&P 500 companies are crushing their earnings. You couldn't write a better script for a market rally.
And yet, this is what we got, a total bloodbath. Bitcoin, which you'd think would be leading the charge, took a serious nosedive. This is the heart of the paradox. All the big scary threats that were holding prices down seemed to just evaporate. But the market didn't just stay flat, it dropped. So the billion-dollar question is, why? Okay, so where do we even start to find the answer? Well, it looks like we have to go digging for the cracks in all this so-called good news. Because when you get past the flashy headlines and read the fine print, turns out maybe it wasn't so great after all. And a good place to start is that big Federal Open Market Committee meeting.
And this right here shows the disconnect perfectly. The headline everyone saw screamed, "Rate cut approved." Awesome, right? But the reality? Fed Chair Jerome Powell gets up there and basically pours a bucket of ice water on the whole party, saying a December cut was far from a sure thing. The headline celebrated the end of QT, but Powell's comments raised the terrifying ghost of stagflation. The market is smart. It read between the lines and saw a Fed that was starting to look like it was losing control.
So what the heck is stagflation? Well, to put it simply, it is the Fed's absolute worst nightmare. It's when prices for everything are going up, that's your inflation, but at the exact same time, the economy is slowing down and the job market is getting weaker. See, normally the Fed can fight one or the other, but fighting both at once? It's incredibly difficult because the tools to fix one problem usually make the other one way, way worse.
And this quote from Powell, this is what sent a real chill through the markets. When the head of the Fed calls the situation challenging, that's basically code for, Houston, we have a problem. He pretty much admitted they're facing rising prices and rising unemployment at the same time. And that little admission was enough to completely overshadow any good news from the rate cut.
Okay, so the Fed meeting had some hidden landmines. I get it. But what about that super successful US-China meeting? That was just straight up good news, wasn't it? Why didn't that give the market a lift?
Well, the answer is a classic market concept. It was already priced in. You got to remember the market is a forward-looking machine, and a positive outcome for that meeting was so widely expected for weeks that traders had already made their moves. By the time the handshake actually happened, there was no surprise left to push prices higher. The good news was already baked into the price.
So we've got these big macro fears and some priced-in news. But that still doesn't really explain why crypto got hit harder than everything else. To understand that, we need to look at what's going on inside the crypto world itself. Let's talk about its hidden headwinds.
Turns out there are 4 major things putting a ton of selling pressure on the market right now. First, the Bitcoin ETFs have seen net outflows. More money is leaving than coming in, mostly from retail. Second, you have the OG whales. We're talking long dormant wallets from 2010 and 2011 that are waking up and finally taking profits. Third, some big crypto treasury companies are being forced to sell their holdings. And finally, some market makers are still offloading their positions to recover from some recent losses. You put all that together, it's a perfect storm of sell pressure.
And this gets to a really fundamental difference. The stock market is ultimately driven by company earnings and profits. But crypto, for the most part, it isn't generating revenue. It's a flows game. All that matters is whether more money is coming in or going out. And as we just saw, there have been some pretty big outflows, and that puts a really heavy weight on the price.
So, we've gathered all the clues, the macro fears, the crypto-specific headwinds.
All of this evidence really points to two major competing theories that try to explain everything that's going on. Let's lay them out.
So on one side, you have Theory 1, the fundamentalist view. This camp says the market is acting rationally. It's looking at the fear of stagflation, it sees the real selling pressure from ETFs and whales, and the price is dropping because of it, simple supply and demand. On the other side, you've got Theory 2, the technical view. These folks argue that all that fundamental news is just noise. The news is just a convenient story to explain a price move that was going to happen anyway. For them, this downturn is a deliberate, planned move to shake out nervous investors before the next big push higher.
So which is it? Is this a rational reaction to some genuinely worrying data, or is it a cynical market move to set up the next big trade?
Well, like with most complicated things, the truth is probably somewhere in the middle. It's likely a combination of both. The fundamental fears and the real selling pressure create the perfect environment, the fuel, really, for a technical correction to happen. The bad news creates the fear you need to shake out the weaker hands, which achieves the technical goal of clearing the deck before the next major move.
And that leaves us with one final thought. In a market that's so heavily driven by psychology and by stories, does it really matter what the real reason for the drop was? Or is the most powerful force simply the story that the market decides to believe? It's something to think about.